All right, we've got the markets in rally mode. A lot of this has been sparked by inflation that has come in cooler, both on the consumer side in the U.S. and today on the producer side. And what's also been interesting when you look at the rally has been sort of the broad-based nature of it very recently. Yes, for the year, most of the gains are still in those so-called Magnificent Seven. And while those have held up, you do also see broadening participation from the financials, from the materials, even from energy and industrials. So you are getting that broadening, that persistent complaint of the market that it's just been too narrow is starting to unravel. This as we're sitting on the doorstep of earnings season. Today, we got a read from Delta and Pepsi. While they're boosting their forecasts, we're going to get a key read of the U.S. banks tomorrow, so that could affect the direction of things. Let's bring in Octavio Marenzi. He's the CEO and founder of Opimas. And Octavio, as long as I've been speaking with you, you've been concerned about the downside risks to the S&P 500. We're sitting on some pretty nice gains here. Why has that sort of confounded your expectation? And do you take comfort in the broadening out of the rally recently?
Well, listen, I think it's said for some time that it's all depending on the Fed's policy in terms of interest rates. And what we're starting to see is, look, it looks like very much like we're coming to the end of their increase cycle. So I think most people expect them to raise another 25 basis points and then at least wait. So they're going to sit on their hands for a while and basically not increase interest rates further, despite the things that Jay Powell's been saying in public, that he's this heroic inflation fighter and he'll slay the beast and do whatever it takes to do that. I expect him to basically now wait and take a pause and potentially then before the end of the year start to decrease interest rates. And that's basically what I've been saying for some time, is as long as the Fed is not decreasing interest rates, we're going to see sort of fool's rallies, and it will go up and down a bit, but nothing very convincing in either direction. I think we might be coming to the end of that process now, and the Fed might start to actually decrease interest rates by the end of the year, and then we'll see a very strong market rally. And what we're seeing is the anticipation for that, basically. My, Octavio, are you becoming bullish?
Well,
you know, you've accused me on this TV show of actually being really boring in terms of my investment advice, and I've sort of taken that to heart. So maybe my recommendations are a bit boring, but no, I think there's a turnaround. I think we've seen this tightening, and of course, in a tightening cycle, stocks do not do well and bonds do not do well, and basically we're getting to the end of this now. So I think yes, I'm turning slightly bullish, cautiously optimistic.
Hey, you know what? In money, boring is beautiful. So that was actually a compliment to you, Octavio. Let's talk about the financials, though, because if there's any sector that has not re-rated, certainly back to post-Silicon Valley Bank levels, it has been this sector, with the exception of JP Morgan Chase. Is this one of those sectors that you would want to go into if you were to start to turn cautiously optimistic?
Look, I think sort of the mainstream banks, or those banks that have a diversified business model, like JP Morgan or Bank of America or Citibank or people of that sort, I think are going to do pretty well in this cycle and are starting to look very encouraging. I think the risk there was that basically, as we saw interest rates go up very dramatically, that a lot of depositors would pull out their deposits. We saw that at some of the regional banks earlier this year, basically, and they got into a lot of trouble. But you know, when you can get 5 or 6% on a 1-month US Treasury, why leave the money sit in a bank account? However, it seems a lot of depositors are doing just that, and deposits have ended up being much stickier than I thought they might have been. So people are leaving their money in the banks, which helps them enormously in terms of lending capabilities and how much they can lend out. It helps them tremendously in terms of the net interest margin, so that's looking pretty good. I think the banks are sitting pretty as well because we've got a very, very low delinquency rates, even on some areas that you might expect to be troublesome, like commercial real estate. Default rates are actually very, very low there as well, at historic low levels. Now, that might change in the coming months, but so far it's very, very encouraging. So everything looks really good for those banks more broadly. If you, however, turn around and look at the investment banks, people like Goldman Sachs and Morgan Stanley, well, the picture does not look that great. So in terms of investment banking activity, yes, we've seen a bit of an increase in Q2, but from very, very low levels. Trading volumes have basically been more or less flat, up a bit, not terribly encouraging there. So the investment banking side, the wealth management side of things is not looking as fantastic as the sort of the Main Street banking activities.
So if you like the Main Street bankers, do you use tech as kind of a source of funds? Do you see profit taking place in tech as the rally broadens out?
I think tech is going to be very well positioned. So I wouldn't expect people basically to rotate out of tech into banks. Much rather, I expect people to move out of having invested in money market funds or fixed income funds and move that into the equities market. So I think the rally will come from there, not from someone rotating out of tech into financials or more broadly. It's going to come out of all the money that's poured into basically fixed income funds and money market funds.
I want to throw a thought at you, and I feel like you'll be able to take this, which is, people lament about the heavy weight that the TSX has towards the banking sector and its oligopolistic nature. And at the same time, they talk about the concentration in the rally in the U.S. being around tech and the so-called Magnificent Seven. But is it possible that the Magnificent Seven is the U.S. equivalent of our banking sector, that it is becoming an oligopoly there as well, a well-cashed up one as well, relatively low valuations, and that it is very different from, say, the tech bubble of 2000?
Well, is the Canadian banking sector like the US tech sector in terms of concentration in a handful of names? Yes, that certainly is the case. But I would say that in the banking sector in Canada, all these big six banks basically offer pretty much exactly the same thing. They're competing head to head with exactly the same services. I don't think you can say that of the Magnificent Seven in the US in terms of the tech sector. So it's not really a technology oligopoly because they all provide very different things, and there's some overlap between them here and there. But overall, Facebook and a Google do very, very different things. They're not at all providing the same kinds of services. So that I think is where the comparison becomes a bit strained. But yeah, I mean, the Canadian market banking sector, an oligopoly. Yeah, there's six big banks. I don't know if six is too many to be an oligopoly. Perhaps there are a couple of smaller banks, but now that they seem to be evaporating as well and being sort of emerged into the larger ones as well. So yeah, kind of an oligopoly. I wouldn't say quite. I say oligopoly for me means two or three, perhaps. Six, I think, still keeps people on their toes and competing with each other.
All right, Octavio, thanks so much.